Picture this: a simple supply contract that contained what would become one of the shrewdest equity deals in automotive history. Two guys without college degrees, just a couple of mechanics, really managed to secure 10% of Ford Motor Company. Through this single agreement, they went on to build a multi-million-dollar automotive empire. But here's the kicker. Their story ends in a way that should make every investor think twice about risk management. John and Horace Dodge weren't born with silver spoons in their mouths. Born in 1864 and 1868 respectively, these brothers grew up in a working-class Michigan family where their dad fixed machines for a living. But even as kids, they showed a business sense that was way ahead of their time. When they were teenagers, they spotted some rich guy cruising around town on an expensive high-wheel bicycle. Instead of just being jealous, they saw an opportunity. They grabbed some scrap metal and built their own version, one that was just as good as anything you could buy in a store. This wasn't just about having good hands with tools. They were already thinking like entrepreneurs, figuring out how to reverse engineer products and control costs. After moving to Detroit in 1886, the brothers worked their way through various machine shops. At Murphy Iron Works, they started making a name for themselves with precision work that had other mechanics talking. But the real breakthrough came when they spotted a gap in the market that nobody else was paying attention to. In 1897, Horace invented the world's first dirt-proof ball bearing. Sounds simple, right? This little innovation solved a major headache for bicycle manufacturers everywhere. John immediately understood that having great tech meant nothing if you couldn't get it to market fast. He went straight to investor Fred Evans with a business plan that was impossible to turn down. Together, they launched Evans and Dodge Bicycle Company. This partnership gave the brothers their first real taste of startup capital. But more importantly, it taught them how to work with money people, a skill that would pay off big time later, too. Years later, they sold the company to Canada Cycle and Motor Company for $7,500. The pricing was brilliant. They walked away with serious cash while keeping enough firepower to make their next move into the much bigger automotive game. In 1900, the Dodge brothers used their bicycle money to open a machine shop in Detroit. Their game plan was crystal clear: become the go-to supplier for this new automobile industry that everyone was talking about. It didn't take long for car companies to notice their precision work. Olds Motor Works came knocking, wanting them to manufacture transmissions. The brothers knocked this contract out of the park. Olds immediately came back with an even bigger order, but then Henry Ford showed up. This guy had already failed twice trying to start car companies, and here he was, taking his third shot. The Dodge brothers had a choice: stick with the safe bet at Olds, or roll the dice on Ford's risky venture. They chose Ford, and that decision changed automotive history forever. The 1903 contract between the Dodge brothers and Ford is basically a masterclass in deal structure. These guys thought of everything. First up, cash flow protection. Ford had to pay them $10,000 within 5 days of any invoice. This meant the Dodge brothers would never get hung out to dry waiting for payments next. Equity upside. They got 10%. A Ford Motor Company, which looked crazy risky at the time, considering Ford's track record of failures. But here's the genius part. If Ford went belly up again, the Dodge brothers would own everything. It was like having a put option that protected them from total disaster. In return, they had to borrow $75,000 to buy equipment for Ford's production needs. This leverage structure let them control a massive potential payoff without putting up all their own money. Ford's success blew everyone's minds, including the Dodge brothers. Not only were they pulling in steady cash from their supply contracts, but their 10% stake was growing more valuable by the day. By 1910, the Dodge brothers had become Detroit's biggest auto parts supplier. Their factory was cranking out hundreds of transmissions, axles, and engine components for Ford every single day.
Ow.
This scale gave them serious cost advantages in everything from raw materials to quality control. But the real gold mine was the education they were getting. They learned every aspect of car manufacturing, supply chain management, quality control, cost accounting, marketing. This knowledge would become the foundation for their own automotive empire. In 1914, Right when their partnership with Ford was humming along perfectly, the Dodge brothers dropped a bombshell. They were ending their relationship with Ford to start their own car company. The business logic was rock solid. First, they'd mastered automotive manufacturing inside and out. Second, being Ford's supplier was capping their growth potential. But most importantly, they spotted a huge hole in the market. The car industry was basically split between two extremes. Ford's Model T was all about rock-bottom prices for the masses, while luxury brands served the wealthy. The Dodge brothers realized there was a massive gap in the middle. People wanted something more reliable and durable than the Model T, but they couldn't afford luxury prices. The success of the Dodge Model 30 is a perfect example of hitting the sweet spot with product positioning. These guys weren't trying to be the cheapest. They were going for best value. While most cars still used wooden frames, the Model 30 had an all-steel body. This might seem like a small change, but it solved a major pain point for consumers: durability. Wooden frames would warp and crack over time. But steel bodies could last for years longer. The 35-horsepower engine was another smart choice. It had more power than Ford's 20-horsepower Model T, but it wasn't over-engineered like luxury cars. This power level was perfect for regular families' daily driving needs. The pricing strategy was brilliant too. The Model 30 cost more than a Model T but less than luxury cars, hitting the expanding middle class right in their comfort zone. The Model 30's market performance was off the charts. For months after launch in 1914, they'd sold 5,000 units. By 1916, Dodge was America's second-largest car manufacturer, trailing only Ford. This explosive growth wasn't just luck. It was backed by a complete business system. The Dodge brothers built a nationwide dealer network so customers could buy and service their cars locally. They pumped money into production facilities to keep up with demand. Brand building was huge too. Dodge brothers, dependable, reliable, sound became their tagline. This positioning nailed exactly what their cars offered and stuck in customers' minds. The financial numbers were staggering. In just 2 years, Dodge Motor Company went from zero to a valuation in the tens of millions, making it one of Wall Street's World War. I dropped an unexpected business opportunity right in the Dodge brothers' lap. The U.S. military desperately needed reliable vehicles. Dodge's reputation for durability made them a perfect fit. Military contracts were way more lucrative than civilian sales. Government buyers cared more about quality and delivery than price, and they ordered in massive quantities. The Dodge brothers quickly retooled their production lines to pump out military trucks and ambulances. When these vehicles proved themselves tough and reliable on European battlefields, the Dodge name became famous worldwide. Military success was the best advertising they could have asked for. The war business didn't just bring in huge profits. It also taught the brothers how to manage large-scale production. These skills would prove invaluable when they shifted back to civilian markets after the war. Massive business success didn't translate into personal happiness for the Dodge brothers. Running a rapidly expanding automotive empire required incredible time and energy, leaving almost no room for rest or fun. Worse yet, the enormous pressure drove them to drink heavily. Business socializing in those days involved lots of alcohol, and the Dodge brothers gradually lost control of their consumption. This didn't just hurt their health, it damaged their social standing too. Detroit's high society started shutting them out. The Grass Point Country Club refused their membership. Applications, which was a major status symbol back then. Bar fights that made newspaper headlines further tarnished their reputation. Most dangerously, heavy drinking was destroying their health, setting the stage for the tragedy that would follow. In 1920, the global flu pandemic completely changed Dodge Motor Company's fate. The Spanish flu killed millions worldwide, including both Dodge brothers. The tragedy started during a routine business trip. While attending the National Automobile Show in New York, Horace caught the flu. John, being the loyal brother he was, stayed to take care of Horace and ended up getting sick too. John's condition deteriorated faster. The flu triggered pneumonia complications. And on January 14, 1920, he died at age 55. His death shocked the entire automotive industry. Horace, devastated by losing his brother and business partner, seemed to recover briefly, but the double blow of illness and grief was too much. On December 10, 1920, Horace also died from flu complications at age 52. From a risk management perspective, losing both founders simultaneously exposed a fatal flaw in family businesses. Too much key-person risk concentrated in too few people. The sudden death of both Dodge brothers threw their automotive empire into serious succession chaos. Neither had designated clear successors or established proper corporate governance structures. Making matters worse, their widows and children didn't understand the automotive business and couldn't effectively manage such a complex industrial operation. Investors started worrying about Dodge Motor Company's future. Stock prices took a nosedive. Suppliers and dealers began reassessing their relationships with Dodge too. After the founders' deaths, many business partners worried about major strategic changes and started looking for alternatives. The death taxes on the brothers' enormous personal wealth created severe cash flow pressure for their families. To pay these taxes, the families might have to sell company shares, which only made investors more nervous. Walter Chrysler saw the Dodge family's crisis as a once-in-a-lifetime acquisition opportunity. As a seasoned automotive executive, Chrysler understood the true value of the Dodge brand and manufacturing capabilities. In 1928, Chrysler Corporation acquired Dodge Motor Company for $175 million. While this seemed like serious money at the time, from today's perspective, it probably massively undervalued the long-term worth of the Dodge brand. After the acquisition, Chrysler integrated Dodge into its automotive lineup. Dodge continued operating as an independent brand, but within Chrysler's overall strategic framework, the acquisition's success came down to Chrysler's perfect timing and negotiation strategy. He struck when the Dodge family most needed cash, securing a brand with enormous potential at a relatively low price. Nearly a century later, Dodge brand still holds major real estate in the global automotive market. Looking back at Chrysler's acquisition price, this might be one of the most successful brand purchases in automotive history. Today's Dodge focuses on high-performance vehicles, with models like the Challenger and Charger dominating America's muscle car market. Brand valuation firms estimate Dodge is currently worth billions of dollars. From an investment return perspective, Chrysler's $175 million investment in 1928 has generated dozens of times that return over nearly 100 years. This proves the lasting value of the brand foundation and technical innovations the Dodge brothers created. Even more importantly, the Dodge brothers' innovations, all steel bodies. Hydraulic brakes are still standard features in modern cars. Their technical legacy might be worth even more than the brand's commercial value. The Dodge brothers' story is one of the most dramatic success and failure cases in American business history. From a business standpoint, they nailed almost every key decision: precise market positioning, smart partnership choices, excellent product strategy, efficient production management, but their tragic ending offers valuable risk management lessons. For modern companies, key person risk, missing succession plans, inadequate governance structures, these problems still plague family businesses today. The Dodge brothers' lives illustrate a brutal business truth: technical innovation and market success can create enormous wealth, but only proper risk management and succession planning can make that wealth truly last. Their story reminds us that while chasing business success, we can never ignore the fundamentals of sustainable enterprise building today. When we see Dodge vehicles still cruising our roads, we should remember those two brothers who changed the automotive industry and the business wisdom and warnings they left for future generations.